you on the first chapter, and the topic is terms of engagement. We'll just get into that. Question number 1. For a compilation or review engagement, which of the following is a false statement regarding communications between predecessor and successor accountants? So the false should be in our mind, because we should not go for the positive ones. Now we need to look out for the negative, because it is a false statement. A successor accountant is required to communicate with the predecessor accountant in connection with acceptance of a compilation or review engagement. Inquiries may be oral or written. Matters subject to inquiry include information that might bear on the integrity of management and the predecessor's knowledge of any fraud or non-compliance with laws and regulations perpetrated within the client. If the prospective client refuses to permit the predecessor accountant to respond, or the predecessor response is limited due to unusual circumstances, the successor should consider the reasons and implications in connection with acceptance of the engagement. So, what is a false one? We need to see the negative. So we know about review, compilation, and audit examination. So we already saw the tabular format in which we already knew the points. A successor accountant is required to communicate with the predecessor accountant in connection with the acceptance of the compilation of review engagement. This is required only for audit purpose, not for compilation or review. Since it has come as the first point, and we are clearly 100% assured of this answer, I feel not to go for other three. Probably you might read, because it's a big one. It's very evident from the fact a successor account is not required to communicate with predecessor in case of compilation of review. So since it's asked the false, A is the answer for it. Okay. Yeah, a successor accountant is required to communicate, which is wrong. So we'll go to question number 2. Which of the following factors most likely would cause a CPA not to accept a new audit engagement? Not to accept. Okay. Management reputation for failing to provide schedules to prior auditors on a timely basis. The CPA's inability to review the predecessor auditor's working papers. The CPA's lack of understanding of the entity's operation industry, and management's unwillingness to make all financial records available to the CPA. So this is about accepting an audit engagement. So it is between auditor and the client. So what could be the reason that can make CPA not to accept? The first point, what is that? Management reputation for failing to provide schedules to prior auditors. What is the business if he is not providing to his prior auditors? I don't find this to be a good point. Then the CPA's inability to review the predecessor auditor's working papers. See, the working papers of predecessor auditor may be required to form certain conclusion or to know certain things, but it might not. It is not a high point or a maximum thing to say whether to accept or not to accept an audit. It is not a valid point. Then the CPA's lack of understanding of the entity's operation. The CPA should know about the client's industry, but he can know while being on engagement. It is not a prerequisite that he should require have to have all the knowledge before he conducts audit. No.
Prerequisite knowledge is not required.
It's not required. You can get to know about the client while during the engagement. Then management unwillingness to make all financial records available to the CPA. There comes a restriction here. See, you are there to do an audit engagement. You are not there for review or compilation. For audit engagement, the scope should be there. You should be given access to all financial records. Their management unwillingness to make all financial, meaning he's not ready. He doesn't want you to do. So he's not interested probably. So this is the one point which is very valid for a CPA to take a decision. This decision box that CPA not to accept audit engagement could be because of, not could be, it's because of management unwillingness to make all financial records available to CPA. So D. Yeah. Then question number 3. Which of the following factors most likely would cause an accountant not to accept an engagement to compile the financial statement of a non-issuer? A lack of segregation of duties in the entity's accounting and payroll departments. I don't find. The indications that reports of asset misappropriation are not investigated by management. The entity's intention to omit from the financial statement substantially all of the disclosure required by GAAP. Management acknowledgement that the financial statements will be included in the written personal financial plan. The first one is clearly no, that is not the one, because a lack of segregation of duties in the entity's accounting and payroll have no business to do with this compilation, where the auditor will say, I will not accept. B, indications that reports of asset misappropriation are not investigated by management. So it is some we will keep it very close to us. Then we'll go to C. The entity's intention to omit from the financial statements substantially all of the disclosures required by GAAP. Because compilation is what the financial statements, whatever has been done by the financial statement of the client, you are going to compile and keep it in a proper way, and then that is the engagement. You are going to compile the financial statements. You are not going to make an audit. So in this case, intention to omit from the financial statement substantially all the disclosures, that will be taken care while doing the audit. Okay, then not for compilation. Then D, management acknowledgement that the financial statements will be included in the written personal financial plan. Even this doesn't come under your compilation. The first C and D doesn't. Whereas indication that reports of asset misappropriation are not investigated by management. See, compilation means you are going to compile the financial statements, and there is a point stating indication that reports of asset misappropriation are not investigated. Meaning there is a known case of asset misappropriation for which the client is not going to make any investigation for that purpose. So the auditor can very well say, I'm not going to compile the financial statements, having known the fact there's an indication that reports of asset misappropriation are not investigated by management, because be it an audit or any other thing, it is come to the some sort of integrity about the management, whether this management is taking his business in a good sense, whether it's an integral part to be he's having that integrity for us to have this engagement with this client. So indications saying there is an asset misappropriation and management is not taking any action on that particular case. So in this case, an auditor can take a decision whether to accept or not to accept the engagement to compile, because other 3 points are nowhere close to this compilation. So the answer number B is the correct one for not to accept an engagement to compile. Yeah. Then question number 4. Which of the following circumstances would permit an independent auditor to accept an engagement after the close of the fiscal year? You need not go through any points. I will give one technique. In any of the question, if you say anything related to closing fiscal year, it is mostly it is related to inventory. Okay. Issuance of disclaimer of opinion as a result of inability to conduct certain tests generally accepted auditing standards due to the timing of acceptance of the engagement, assessment of control risk below the maximum level, receipt of an assertion from the preceding auditor that it will be able to go in a continuous going concern, remedy of limitations resulting from accepting the engagement after the close of the end of the year, such as those relating to existence of physical inventory. Which of the following circumstances would permit an independent auditor to accept an engagement after the close of the fiscal year? So what would be which you could not have done since because the year is closed? Because in the current year, during the year end, an auditor will be doing an engagement wherein he will also be involved in the physical inventory, stock taking. So in such case, when the scope is limited, saying that the year is closed without being an auditor engaged in doing certain activities, so he might be having in mind, oh, we have not done certain engagement. What could be that particular point? So which of the following circumstances would permit an independent auditor to accept engagement after the close of the fiscal year? So here you would have been thinking that inventory closing, that stock taking, he was not involved. So remedy of limitations resulting from accepting the engagement after the close of the fiscal year, such as those relating to the existence of physical inventory. See, all other things doesn't have anything to do with your fiscal year closure. Okay, so this you can read the point because it's all very big points here. So that is not very close. If you see any question related to year and then inventory, you can directly go. And question number 5, a CPA is considering whether to accept an engagement to prepare finance. I only highlighted, made it bold to prepare because students might not see it properly. I just made it bold for you to just see that. Now you can understand why I had made it bold. The CPA is considering whether to accept an engagement to prepare financial statement because it is a non-audit services for a new client. Which of the following statement is correct regarding the independence of the CPA? The CPA should be independent of the client. The CPA is not required to make a determination whether CPA is independent of the client. The CPA is required to disclose in the engagement report in relation with the client personnel. And then CPA should obtain management understanding regarding the benefits of an account being independent of a client. Since I have made it bold, so now you could easily take the answer because it is a non-audit services and auditor is not supposed to be, not required to be independent. So where it is not independent, The CPA is not required to make determination of whether CPA is independent of the client. So point number B. For this, the crucial is you need to read the question properly, and wherein you need to see prepare, because back of your mind you will be thinking it is an audit engagement. Then you will say, you will give the wrong answer. The CPA should be independent of the client. That is the reason I made it bold. Okay, read the question carefully. Then question number 6. Smith CPA has been asked to issue a review report on the balance sheet of a co-owned company, a non-public entity, non-issuer, and not on the other related financial statement. Smith may do so only if Smith compiles and reports on the related statement of income, retained earnings, and cash flows. Smith is not aware of any material modification needed for the balance sheet to conform with GAAP. The scope of Smith inquiry and analytical procedure is not restricted, and Cohn is a new client, and Smith accepts the engagement after the end of Cohn's fiscal year. So, what is the engagement here? It's talking about, it's asked to issue a review report. Review meaning, what should come into the mind? Inquiry and analytical procedure. Now, A, Smith compiles and reports on the related statement. So, nowhere close. Smith is not aware of any material modification need for the balance sheet. It is somewhat close. The scope of Smith's inquiry and analytical procedure is not restricted. So, Cohn is a new client fiscal year, that is immaterial. Now, review report, you know, review means inquiry and analytical procedure. Then you go for other things. Material modification also, there are certain things, but Smith may do so only. They asked to issue review a non-public and not on the other related. Smith may do so. He will accept the review engagement only if what? The conditional scope of Smith inquiry and analytical procedures is not restricted. If these analytical procedure and inquiries are not restricted, he will easily take the engagement of review. It is question 6, point number C.
The scope of Smith's inquiry analytical procedure is not restricted.
Yes, because review meaning inquiry and analytical procedure. Okay. Question 7. Which of the following statement is correct regarding a review of non-issuer financial statement in accordance with statement on SSARS, Statement of Revenue Services? The accountant is required to assess the risk of fraud. It is not necessary for the accountant to manage the representation letter. An opinion is issued in the review report. The accountant must be independent to issue the review report. So, which of the following statement is correct regarding a review? Review means the accountant is required to assess the risk of fraud? No. That is only in case of your audit engagement. It is not necessary for the accountant to obtain a management representation letter. Management representation letter is not required only for compilation, but for review it is required. Then opinion is expressed in the review report because it is a limited assurance. So it's not, there is no opinion. Assurance wise, it is a limited assurance. Then accountant must be independent to issue the review report. Yes, only for compilation, independent not required. For review and audit, it is required. So it should be point number D is correct. That is D is correct. Then question number 8. Which of the following would a successor auditor ask a predecessor auditor to provide after accepting an audit engagement? I made it bold. This after accepting was not bold. I made it bold because while reading the question, there are two things, before accepting and after accepting. You might think it is before and give a wrong answer. So you need to read the question carefully. I am just saying every time you read a question, read it properly. Before you get into answer, read the question.
So you can even tell that 2 times you got to read the question.
Yes.
That can...
Correct. You need to be confirmed about the question first, then before going for the answer. Okay. Disagreement between the predecessor auditor and management as to significant accounting policies and principles. The predecessor auditor's understanding of the reason for change of auditors. Matters that may facilitate the evaluation of financial reporting consist between the current and previous years, and fact known to predecessor auditor that might bear on the integrity of management. Had the question been before accepting, 3 of these are correct. Since it is said after accepting, only 1 is right out of this. So all these 4 answers are correct, but the only trick is before or after. So after accepting, only 1 is correct. Okay, now I will explain one by one. Disagreement between predecessor and management as to significant accounting policy is very important before you accept an audit engagement, because after you accept, what is the big deal in knowing the disagreement between them? Okay, this should be known before you. So this is ruled out for after. Then the predecessor auditor's understanding of the reasons for change of auditors. This is also similar. After you accept, what is the point in knowing the predecessor auditor's understanding of the reason for change? This should be known before accepting. So these two. Then go to the third. Matters that may facilitate the evaluation of financial consistency between the current and prior years. What is the point before you accept to know this point? Matters that may facilitate consistency between current and previous years. You have still not been accepted, not accepted the engagement. What is the point in knowing this consistency between previous and current years? You have no business. So this is the point which you should consider after accepting. Matters that may facilitate the evaluation of financial consistency between the current and previous prior years, because you already assumed the role. Now you can know about the previous and current year. Now you need not know about the change in auditor, then disagreement. Then come to the fourth point, facts known to the predecessor auditor that might bear on the integrity. This is very, very important before you accept or not after accepting. I'm not saying it's not important, very important. But what stage? Before you accept it. After you accept it, it's immaterial. That's all. Before accepting, it is important. Now it is immaterial. So the material, what you need to have the point in before you is point number C. Matters that may facilitate the evaluation of financial reporting consistent between the current and previous years. So the good thing about it is the question. Before or after accepting is the point which you need to give more importance. Okay. Then question number 9. See, matters that may facilitate evaluation. Then question number 9, Stone CPS accepted new audit engagement. This audit engagement, after asking the predecessor auditor about matter related engagement acceptance prior to ending the bid, what additional inquiries should be made to the predecessor auditor after engagement acceptance related to the conduct of the audit? So here also has accepted a new audit engagement, meaning he has accepted. Okay. Stone CP has no special obligations to communicate with the predecessor auditor at any stage of the audit process. It doesn't sound good. You can have then. Stone CPA should review the predecessor's working papers relevant to matters that have ongoing relevance with the current period of audit. Fine. Stone CPA is prohibited from making additional inquiries or the predecessor auditor after engagement. That is also doesn't sound good. Then Stone CPA should review the predecessor audit files in their entirety, even if the predecessor wishes to limit access. This also doesn't sound logical, because a predecessor auditor is not going to show you something, but you have to see it in entirety. That point itself something you can ignore totally. Stone CPA should review predecessor audit files in their entirety, even if the predecessor wishes to limit the access. That you cannot do. You cannot ask him to open and then you can see. No. Then first point is also not right. Has no special obligation to communicate with the predecessor. Why? He can at any point, with the consent of the client, he can go to the predecessor working paper. So 1 is also ruled out, D is also ruled out. Then between 2 and 3 now. Stone CPA should review the predecessor working papers relevant to matters that have ongoing relevance with the current period's audit. Even if you don't know the thing, by reading this particular point, it is somewhat very close to any of the question. Okay, so keep it aside. You can go for question C, point C. Stone CPA is prohibited from making additional inquiries of the after engagement acceptance. Here also it is ruled out. So A, C, and D are ruled out, and B is the one. Stone CPA should review the predecessor working papers relevant to matters that have ongoing relevance with the current period's audit. This is the point. Because he has already accepted the engagement. Then, question 10. Which of the following activities by small business clients best demonstrate management integrity in the absence of a written code of conduct? Developing and maintaining a formal description of accounting procedure. Documenting internal control procedures using flow chart rather than narratives. Emphasizing ethical behavior through oral communication management example. Reporting regularly to the board of directors about operations and finances. So at the first time when you see this answer, you will find everything is very close to the question. But one point you can just make a note, this auditing terminology, integrity, then professional judgment, skepticism, objectivity, independence. Likewise, you also have something called ethics. Okay. Just to see if all the points are very close to the question, all the points given in the answers are very close to the question. If you feel like, look out for keywords. Okay. Developing and maintaining formal descriptions of accounting procedures. Okay. That is also a good one. In the absence of written code, this will also might help developing and maintaining formal description. Then documenting internal control procedure using flow chart rather than narratives. Yes, that is also a best way to make people understand through flow chart. Then emphasizing ethical behavior through oral communication management example. We have a keyword there. then reporting regularly to the board of directors about operation finances. So A, B, and D all look very common, natural, though we cannot say those are all wrong. But very close is emphasizing ethical behavior through oral communication management example, because it is looking for an answer that could demonstrate management's integrity. Management's integrity can be exhibited through certain things, wherein certain auditing terminal also there, emphasizing ethical behavior through the communication could be oral or written, and management example. So it is ethical behavior. It that demonstrates management integrity in the absence of written code of conduct. The explanation I have just given here. Management can demonstrate their commitment to integrity and ethical values by fostering an organizational culture based on integrity and ethical values. Making integrity a basic operating principle, they consistently encouraging and rewarding honesty and articulating the distinction between honest and dishonest behavior. So that is punishing or rewarding honesty without identifying or explaining it, or using an inconsistent standard of honesty. Okay, you can just go through the explanation. Because it is somewhat, all the answers are very close and you couldn't make out. That's the reason I gave this explanation. We go for point number 11. What is the most likely auditor responsive during the engagement acceptance phase of the audit? Management imposes scope limitation in gaining access to the books and records of a material overseas subsidiary, which is likely to result in disclaimer of opinion. Do not accept the engagement. Accept the engagement, disclose the fact that the disclaimer opinion will be issued in the engagement letter. Accept the engagement but communicate a material weakness. Accept the engagement but agree to qualify the opinion. What is the point? Whether you why you want an engagement? Engagement should be properly accepted between two parties, right? When during the signing of engagement letter, one is saying, I will not give this, you should not do this. What is the big point? Why you want to show to the world something great? So we need to take the question in full, and then only we can give an answer. Now we read the question. What is the most likely auditor responsive during the engagement acceptance phase? Management imposes a scope limitation in gaining access to the books. It is the management who wants to have their accounts audited. For an auditor, if not this client, it is another client, right? You should move in you should keep in this platform and see what is the next thing. Management imposes scope limitation in gaining access to the books and records of a material overseas subsidiary. There is a point also, keyword. What is material? Okay, material meaning for an engagement itself, that particular thing is a material, which is likely to result in disclaimer of opinion. Everything they know, if they couldn't see that particular books of records of a subsidiary which is material, it is going to result in disclaimer of opinion. So disclaimer of opinion will come after you get into the engagement, and because of certain limitations, you couldn't see certain access of information. But during engagement phase itself, you know that it's going to be a disclaimer of opinion and which is material. What is the point? What is the need for you to take up that engagement? So when you see all the 4 points, everywhere they say accept the engagement but disclose the fact. Accept the engagement but communicate a material weakness. Accept the engagement but agree to qualify the opinion. Why? There is a simple way for that. Do not accept the engagement. That's it. Because you are very well known, a material thing you couldn't gain access, and by not gaining access, it is going to result in disclaimer. So no point in taking up the engagement. Do not accept the engagement. Okay, now you can read the question and answer. You will better know this is the answer. Question number 12. Which of the following services, if any, may an accountant who is not independent provide? Reviews but not compilation, compilation but not reviews, both compilation reviews, no services. You know, review, compilation, audit, we saw the table format, and which doesn't require independence? Compilation. Compilation but not reviews, right? Because it will be confusing when you read like reviews but not compilation, both, all these things. You should be very clear in your
thought it is
mind.
C.
No.
C.
No. Review and audit are similar. Only some 10% difference will be there between review and an audit. Compilation is almost different. Independence is not required for compilation. Then question number 13. If the predecessor auditor refuses to give the current auditor of a non-issuer access to the documentation, what should the current auditor do? Review the risk assessment of the opening balance of the financial statement, withdraw from the engagement, disclaim an opinion due to scope limitation, discuss the matter with the client's legal counsel. Okay, here I want to give one basic difference between when a client is not going to give access to information, number one, then prior auditor is not going to give information. Who is main for you? Who is the main party for you as an auditor? It is a management. When management himself is going to put restriction, you have the option of withdrawing from the engagement. Okay. So this sort of confusion should be eliminated before you read the question. That's the reason I'm just saying this. Big difference between access of information not provided by the management, that's a client himself, or by the predecessor auditor. Withdraw an engagement for client refusing to give a document is somewhat sensible. But a predecessor auditor not giving or giving not access, withdraw from the engagement, 99% it won't be the case. This you should know, because without knowing this point, if you go in examination, if other points are not convincing, you might probably take withdraw from engagement. That cannot happen. 99% of the case, say close to 100%, yeah, predecessor auditor not providing information, you will not take that option of withdrawing from the engagement. So take it aside. Okay. Now go to the point number C. Disclaim an opinion due to scope limitation. Could be you can disclaim an opinion, but keep it. Then discuss the matter with the client's legal counsel. This also could be a thing. But now we go to the question. If the predecessor auditor refuses to give the current auditor of a non-issuer access to documentation, what should the current auditor do? He is having a lot of options other than B. But you can see, review the risk assessment of the opening balance of the financial statements. As a current auditor, when the predecessor auditor is not going to give certain information, refuses, you have to give more emphasis on the opening balance of the financial statement of this year. That is what you can do, because disclaim an opinion also is the right answer. Discuss the matter with the client's legal counsel is also the right answer. Review the risk assessment is also the right answer. Which one is the most correct if you say? Review the risk assessment of the opening balance. Probably you need to apply the professional skepticism here, because since he is not giving access, you need to give more emphasis and more importance to the opening balance of the financial statement, wherein that would be some material misstatement. Okay, so this is what we have to do. This is a very, very important question. The current auditor should review the risk assessment of the opening balance of the financial statements, because C and D is also somewhat very close to the answer. So one is the best answer is review the risk assessment. Then question number 14. If requested to perform a compilation for a non-issuer in which an accountant has an immaterial direct financial interest, the accountant is independent because the financial interest of the non-issuer is immaterial, not independent and therefore may not be associated with financial statements, not independent and therefore may not issue a compilation report, not independent and therefore may issue a compilation report but may not issue a review report. Now you can say which one is the right answer in this. If requested to perform compilation for a non-issuer in which an accountant has an immaterial direct financial interest, let it be the accountant is independent because the financial interest in the non-issuer is immaterial. Because for our compilation, it is immaterial whether the auditor is independent or not. So the first question itself is not right. If requested to perform compilation, I don't expect an auditor to be independent. So now here is saying accountant is independent because the financial interest in the non-issuer is immaterial. Okay. The accountant is independent. I will not say accountant is independent for doing a compilation. We'll go for point number D. Not independent and therefore may not be associated with the financial statements. So for a compilation, it is enough if he is not independent. So he can get involved with the financial statements. He need not say he is not independent and therefore may not be. That is also not right. Then not independent and therefore may not issue a compilation report. Not independent and therefore may not issue a compilation, because for compilation it is enough if he is not independent. So C is also not right. If he is not independent, he can issue the compilation report. Then point number 4, not independent and therefore may issue a compilation report but may not issue a review report. This is the correct one, because by not independent he cannot issue a review report. That is also mentioned. By being not independent, he can issue a compilation report. That is also mentioned. So point number 4 is D is correct. Other 3 will confuse you, but very clear answer is given in point number D. So all the options you have to read it very carefully. Point number D. Yes. Then question number 15. Now here also I made it bold. Before accepting an audit engagement, a successor auditor should make specific inquiries of the predecessor auditor regarding the predecessor opinion of any subsequent events occurring since the predecessor auditor's report was issued, understanding of the reasons for change of auditors, awareness of consistency in the application of GAAP between periods, evaluation of all matters of continuing accounting significance. Here, 3 points are the points which you should ask after you accept. Only one which you can ask before accepting. So since I made it bold, I'm just emphasizing the fact that read the question properly and this asked for before accepting. And out of the 4, only one you can do before accepting. All other 3 are after accepting. So now go for the 1. What you can do? Opinion of any subsequent events occurring. Subsequent events and all will be material only when you are in the engagement, meaning after you accept. Then awareness of the consistency in the application of GAAP between periods. Between periods itself only after you accept. So it is also ruled out. Then evaluation of all matters of continuing accounting significance. What is the point without even getting engaged in to know these points? The only point which you will be interested to know before you accept is understanding for the reason for change of auditors. So you can ask before accepting the engagement, and if the reason is acceptable to you, then you can take the engagement. If it is not acceptable, even you can not take up the engagement. So that is very important. Understanding the reason for change of auditors is an important point that you can consider asking the predecessor before accepting the engagement. Okay. Question number 16. Which of the following factors most likely would cause a CPA not to accept a new audit engagement? The prospective client's unwillingness to permit inquiry of his legal counsel, the inability to review the predecessor auditor's working papers, the CPA's lack of understanding of the prospective client's operation industry, the indication that management has not investigated employees in key positions before hiring them. The same point we discussed some 2-3 questions before. Okay. Now there should not be any confusion in our mind for the lack of access, unwillingness to permit between the client and the predecessor auditor. The withdraw from the engagement, the predecessor auditor's point is not at all material for us, immaterial. So remove point number B. The inability to review the predecessor auditor's working papers will not make an auditor take a decision whether to accept or not. So B is immaterial. Then first one, the prospective client's unwillingness to permit inquiry of its legal counsel. That is a valid point. Keep it. Then point number C, the CPA's lack of understanding of the prospective. Here also, as we already saw, during the course of engagement, you can know about the understanding and prospective of the business. You need not take this as a point for not accepting it. So keep it aside. So you had made B and C aside. Now go for point number D. The indication that management has not investigated employees in key positions before hiring them. What is the point for you in whether they interviewed them properly or not? So that is not the fact for you to take a decision whether to accept. So the only valid point is the prospective's client's unwillingness to permit inquiry of its legal counsel. If you know that before itself that is showing its unwillingness, better not accept the engagement. It's point number A. Right. Question number 17. Malone CPA wants to propose on a prospective audit engagement, but is unable to communicate with the predecessor before the bid proposal is due. What are the implications on Malone CPA to bid on this engagement? Once again, read the question. Wants to propose on a prospective audit engagement, still not accepted, okay? But is unable to communicate with the predecessor auditor before the bid's proposal is due. Prospective, okay. What are the implications on Malone CPA able to bid on this engagement? Malone CPA is prohibited from bidding. We cannot take that decision before reading other points. Malone CPA can bid on and accept the engagement without making any inquiries of the predecessor auditor as long as communication will be made prior to the start of field work. Malone CPA can bid on and tentatively accept the engagement as long as acceptance is not finalized until inquiries of the predecessor have been completed. And Malone CPA can bid on the engagement but give no indications of even tentative acceptance until required predecessor auditors have been completed. You should not look out for any any absolute thing. No. The first one is very absolute. Malone CPA is prohibited from bidding on engagement. Then what is the point in he want to propose on a prospect auditing, unable, he has to communicate, have to communicate with the predecessor auditor before the bid proposal is due. That is an ongoing thing that he need to speak with the predecessor auditor. So the point here is you cannot take up the point saying it's prohibited from bidding on the engagement. No, this is not the point. So remove point number A. B. Malone can bid on accept an engagement without making inquiries of the predecessor auditor as long as communication will be made. No, this is also not right because the point itself, the question itself saying wants to propose on a prospective but is unable to communicate. But his willingness is there before the bid proposal. What are the implications of Malone to bid on this engagement? He wants to he should and he may discuss with the predecessor auditor before going on a bid. There is nothing prohibiting from. So A is taken out, and B is also not right, because accept without making any inquiries, because on any bid, and you have an option to speak to the predecessor auditor before accepting any engagement. So B is also ruled out, because it is saying without making any inquiries, because then all the any risk will be on auditor's head, even before when he's having option to speak with the predecessor auditor before accepting any audit engagement. So B is also ruled out. Then Malone CPA can bid on and tentatively accept the engagement. It's not final engagement as long as acceptance is not finalized until inquiries of the predecessor have been completed. This seems to be a very good normal point here. Then we'll go for point number D also. Malone CPA can bid on the engagement but give no indications of even tentative acceptance until required predecessor activities have been completed, because it is a bid. It is not a normal engagement with an auditor where you can take whether after accepting or making inquiry only you will take the engagement. Since it is a bid, you can, if you have the option of this tentative acceptance, better go for it. So Malone CPA can bid on and tentatively accept, because there is a provision for him to tentatively accept even when the bid is on, as long as acceptance is not finalized until inquiries, because all the probabilities are given here. He can go on, continue on the bid. He can give tentative acceptance before tentative acceptance, and he can also inquire the predecessor auditor, and after getting some certain inquiries for the predecessor auditor, then he can give the final acceptance. So all the points are there in point number C. Point number D is not such flexible, can bid on the engagement but give no indications of even tentative acceptance until required predecessor auditors have been completed. The question itself saying he couldn't do before the bid proposal is due. So only option available based on the question is point number C. He can have that tentative acceptance. As long tentatively he can accept the bid, as long as acceptance is not finalized until inquiries of the predecessor auditor have been completed. So based on the question, you need to go through the points, and the point C exactly fits for the question. Then question number 18, which of the following statement is correct regarding both a compilation and a review of a non-issuer financial performed in accordance with SSARS? For both is asking. The CPA should assess fraud risk. It is only for audit engagement. The CPA must understand a client's internal control. It's not required. The report contains a statement that the engagement is substantially less in scope than an audit. You're not going to give any such statement there. The CPA must establish an understanding with the client regarding service to perform and document it in an engagement letter. Point number D is the correct one, because everything one by one when we went through, it is all eliminated. That's not the correct point. CPA need not do as fraud risk, then must obtain understand internal control not required, and the report should not specifically state it is less than scope. No, it is not in the report. Whereas in an opinion there, in the letter, if you can see the engagement letter, but not here. So in the review or compilation report, you are not going to say this. So the CPA must establish understanding with the client regarding service to be performed and document it in an engagement. That is the correct one, right? Because question itself is about the review engagement. Then question number 19. The objective of our audit is to express an unmodified opinion on the financial statements. Although it is possible that facts or outcomes encountered may preclude us from expressing an unmodified opinion. What is the most likely source of this statement? Auditor's communication with the audit committee, auditor's engagement letter, auditor's report, letter of for underwriters. See, if you see the engagement letter, see, because letter for underwriters is for outside. Even for auditor's report, the report will be read by the users outside. Auditor's communication with the audit committee. It is two different parties. Auditor with the audit committee. Audit committee is those charged with governance. Whereas auditor's engagement letter is a letter even before accepting. It is not going anywhere to outsider. It is between the client and the audit. The objective of our audit is to express an unmodified opinion. It is in the engagement letter. It is an auditor's point. The objective of an audit is to express an unmodified on the financial statements. Although it is possible that facts or circumstances encountered may preclude us from expressing an unmodified opinion. What is the most likely source of this statement? This is form part of auditor's engagement letter, because it will not be mentioned in auditor's report, because their outsiders will not see this point saying objective is to express an unmodified. No, the auditor has to give the correct opinion in the auditor's report. Letters for underwriters also does not carry this message, and auditor's communication with the audit committee also doesn't carry this much. It is for auditor's engagement letter. Even before getting into engagement, this wording is used. All others are after the engagement. So one that stands out is auditor's engagement letter. Then question number 20, Patel CPA is entering into new engagement to compile financials to non-issuer. Which of the following is relevant that Patel CPA should ensure is included in the letter? Reference to the respondent accountant is taking related to any supplementary information that management is elected to accompany financial statements, listing of any known material departure from the applicable financial reporting framework. All material departure from the applicable financial reporting framework will be identified. Patel CPA's election to a substantial omit all disclosures. So this is about compilation. Okay. Listing of any known material departure from the applicable financial reporting framework B is for review and audit. Then all material departure from the applicable financial report framework will be identified. That is also in audit and review. Then Patel CPA's election to substantially omit all disclosures. So only when you are engaged in the financial statement, you will have all the disclosures. But in compilation, he doesn't look into, say, election to substantially omit all disclosures. Go to the point number 1. Reference to the responsibility that the accountant is taking related to any supplementary information that management is elected to accompany the financial statements. When he is going to do that compilation of financial statement, you need to look into this particular thing about the supplementary information that management is elected to accompany the financial statement. Whatever the management is going to give is going to compile. So which of the following element that Patel CPA should ensure is included is, this is the point number A. Reference to the responsibility that the accountant is taking related to any supplementary information that management is elected to accompany the financial statements. And question number 20, we have 25, another 5 only. An accountant's compilation report on a financial projection does not contain a range should include a statement that the compilation includes an evaluation of the support for the assumptions underlying the projection. There will usually be differences between the projected and actual results because events and circumstances frequently do not occur as expected. The accountant's responsibility to update the report for future events and circumstances limited to 1 year. The projection is limited to presenting the financial statement information that is the accountant's representation. All the answers for this question seems to be very close. An accountant's compilation report on a financial projection that does not contain a range should include a statement that. So that does not contain a range. Range means any specific period between the range or something. What is that projection? Projection meaning it is something you are projecting what would happen, but not it's an actual. So the two, it is a compilation on a projection that does not contain a range should include a statement that the compilation includes an evaluation report for the assumption underlying the projection. This is a normal compilation, but for the projection, there will usually be differences between the projected and the actual results because events and circumstances frequently do not occur as expected. All the 4 points are related to compilation, but one of the points that is related to projection on a financial projection is there will usually be differences between the projected and actual results because events and circumstances frequently do not occur as expected. This is the exact word for related to the projection. Even you can go to the points.
One of the points.
Which is one of the points?
You told one of the point. Then I am correcting one of the points.
Yes, one of the points. Yes, one of the points. There will usually be differences between the project and actual result because events and circumstances do not occur as expected. This is the point which is related to this particular question. You can go to the other points. The accountant's responsibility to update the report for future events circumstances limited to 1 year because it does not contain a range wherein I cannot say it's limited to 1 year or 2 years. So that is also totally ruled out. Then the projection is limited to presenting the financial statement information that is an accountant's representation. So the answer is the compilation is limited to presenting the financial statements information that is accountant's representation. So it is not the projection. So point number B is the correct answer for this question. Okay. Then question number 22. While auditing the financial statements of a non-issuer, a CPA is requested to change the engagement to review in accordance with statements for accounting and review because of a scope limitation. The CPA believes that client's request is reasonable. The CPA's review report should refer to the scope limitation that caused the change or describe the auditing procedure that have already been applied. So 1 only, 2 only, both 1 and 2, and neither 1 nor 2. So what is the answer that you are going to select? See, be it the engagement, audit, review, compilation. You already saw the levels of engagement. So the one higher level is the audit, the next level is the review, the last one is the compilation. In any of these engagement, an auditor who has been engaged to do a higher level of engagement, after which it has been reduced to the next level, you should not disclose what the original engagement was. And you should not say whatever the reason for the change in the engagement. That is not the point. You should not reveal is the original engagement. You should only give this report based on the engagement, what he has currently done. After having reduced from the audit to review or review to compilation, what is the final engagement for which he is engaged? You should give only the report based on that, and you should not refer to any other thing. So which I am just refreshing that particular point here. Now you see the review report should, the question, I'm going to the review report should refer to the scope limitation that caused the change? No, it should not. Then describe the auditing procedure that have already been applied? No. Meaning is not going to refer to any previous engagement work that you have already performed. So what is the answer that you are going to select? Neither 1 nor 2. D is the correct one. So from higher to lower level engagement, if your engagement is revised, you should not refer to the original engagement at all. In any case, be it the level of work you have done, then the scope limitation, reason, you should not mention any of the previous engagement. So it is neither 1 nor 2. Then question number 23. An accountant has been engaged to review a non-public entity financial that contains several departures from GAAP. If the financial statements are not revised and modification of the standard report review is not adequate to indicate the deficiencies, the accountant should. What are all the things? Inform management that the engagement can proceed only if distribution of the accountant reports is restricted to internal use. Determine the effect of departure from GAAP and issue a special report on the financial statement. Withdraw from the engagement and provide no further services concerning financial statements. Issue a modified review report provided the entity agrees that the financial will not be used to obtain credit. So there are two things here. Financial statements are not revised. First, the engagement auditor has been engaged to review a non-public that contains several departures. So financial statements are not revised and modification of the standard is not adequate. So you have done the thing engagement and modification is also not adequate to indicate the deficiencies, and moreover, it is not also revised. So it is at the higher level. So you can also take the decision which is at the higher level. You need not take certain ifs and buts. So the one inform management can proceed only if distribution, because the question is already saying it is not adequate to indicate the deficiencies. Even and modification of the standard review is not adequate to indicate the deficiencies. Even if modified, it's not adequate. Meaning, what is the only option left to you? If see that option is there, withdraw from the engagement and provide no further services concerning, go for it. Because question itself clearly implied modification of the standard is not adequate. So in that case, nothing to compromise. So you have to take that particular step as to withdraw from the engagement. Now you can go through all the 3 points, because I just want to tell you there are all the cases where you can go for that extreme point, and it's clearly mentioned here. Modification of the standard review report is not adequate to indicate the deficiencies. So in such case, having known that particular point, so only way out for an auditor is to withdraw from the engagement. Then question, that's withdraw from the engagement and provide no further services concerning these financial statements. Question number 24. For an engagement to prepare financial statements, I didn't make bold. It should be to prepare financial statements. When you read the question, read it carefully. You don't think it is an audit engagement. For an engagement to prepare financial statements, which of the following items should be identified in the engagement letter as management responsibility? The preparation of financial statement disclosures, the accuracy of significant judgments to be used in the preparation of financial statements, the determination of level of assurance over the financial statements, the inclusion of financial reporting framework, distribution of the phase of financial statements. And one more point in this question, I initially said, read the question properly. I said only one point, prepare financial statement. That is,
Prepare.
I already said that. There is one more important point to be referred in the question.
Which of the following items should be identified in the engagement letter as management's responsibility?
Yes.
So you say that management responsibility also is a very important thing. Preparation and financial statement disclosure, then that is also for an engagement of preparing, management should give those inputs. Accuracy of significant judgments to be used in the preparation of the financial statement. Yes, because there are a lot of estimates that they got to make in the preparation of financial statement. So determination of level of assurance over the financial statement, that I do not think is relevant for the question. The inclusion of the financial statement framework description on the face of the financial statement. See, that is remotely connected is what I feel like. Now, the matter is between A and B. Oh, with respect to the question, the management responsibility is about A is what I feel like. So I do not know as whether I'm right. You can just convey.
I'll just explain. See, when I said while reading the question, prepare financial statements, then also we'll be thinking about auditor preparing financial statements. That is what the point number one. Point number two, then it landed to management responsibility. So preparing financial statements. Okay. Now, only thing which is removed from this thing we can ignore is point number C, because determination of the level of assurance. Assurance all comes only from the auditor's point. Limited level of assurance and then reasonable level of assurance. There is no assurance from the determination of the level of assurance over the financial statements. But management is having all responsibility for preparation of financial statements and disclosure, then financial reporting framework. But in the engagement letter, which of the following items should be identified in the engagement letter? That is very important. You need to couple that. Three things: prepare financial statements, engagement letter, management responsibility, because you are not seeing anything related to auditor's responsibility. So two important points are prepare financial statements and engagement letter. In the engagement letter, this preparation is a very normal thing. Then inclusion of financial reporting is also a normal thing. But in the engagement letter, management would have clearly specified the accuracy of significant judgments to be used in the preparation of financial statements. So what are all the significant judgments being made and the accuracy for which management is holding the responsibility? These are the things which should be specified in the engagement letter. So it is point number B.
I just also understand it this way. There are a lot of management's responsibility we have in bringing out a lot of things in the preparation of financial statement. So I can just give you examples like depreciation. So because the management has got to know about what is the expected salvage value at the end of its useful life, and they got to create a lot of provisions for warranties, guarantees, and sometimes provision for dismantling. So all that would require a lot of management's judgment only. So why I just made A could be the answer is that. So preparation of financial financial statement disclosure. Now I understand that as a part of preparation of financial statement, that becomes your responsibility. That is not management responsibility. So therefore, I would consider that B is very much appropriate, even though by mistake I have selected A. Very good question. Next.
The last question. AUC 21010 agreement on audit engagement terms requires CPS to establish understanding with the client for each engagement and outline details of that understanding. The understanding should address certain areas. These areas do not include the fee for the engagement, the objective and scope of the engagement, the responsibility of management, limitations of the engagement. Okay, so an engagement letter, so it is a broad term, engagement, terms of engagement. We need to go through what is the responsibilities of management in that engagement letter, what is from the management side it's being provided, and what are all the auditors think from the auditor's point of view in engagement letter. So one such is AUC 21010, because even in engagement only we even the fees for the auditor is also established, because stated, without which we cannot do an audit without having what is the
knowing about what is the
fees. So even that should be there. But this particular point, AUC 21010 agreement, the understanding should address certain areas. These areas do not include. So why I just emphasize the fact of the fee. This particular AUC 21010 doesn't speak about the fee. It speaks about everything. That is the reason I just touched that point for you. So any engagement will have the objective and scope. Very well, all the engagement should have the scope of work. What is that I am supposed to do? What is the objective of this particular audit? What is the scope? Then responsibility from management, and then limitations of the engagement will also be specified. One point which will not be mentioned in AUC 21010 is the fee for the engagement. Yes.
Super.
That is the thing. So with this, we just completing our terms of engagement. All the important points are taken care here.
Okay, thank you. Very nice discussion.
Yeah.